This panel will be moderated by Kwabena, and it's on informed investing, innovations driving growth, a spotlight on the evolving capital markets in Africa. As I said, the moderator will be Kwabena. He's a director at Verdant Capital. Kwabena is responsible for the West Africa and is based in Verdant Capital, Accra office. Kwabena has direct experience working in the international financial institution field as a senior private sector officer at the USAID. Kwabena holds broad corporate entrepreneurial and transactional experience in Ghana and beyond. Kwabena joined Verdant Capital in 2014. So welcome, Kwabena. And the other panel members, you can all join, and then Kwabena will introduce us. So welcome. I don't have a sheet. This is your panel.
This is great.
Yeah.
Where would I meet you from?
Yeah? Or we can do it sitting down, yeah. All right. Wave me.
I'll sit next to you.
Excuse me.
Maybe we should move up one, hey?
Yeah, I think so.
We'll move up one.
It's like everybody's scared of me.
Yeah.
What's going on here, guys? Okay, I'll move up one. Good afternoon, everybody, and a great pleasure to moderate this session. I would ideally have gone through an introduction process, but I think it's always best when it comes from everybody else. I had the pleasure of somebody else introducing me, so I get to leave you in the lurch and get everybody to introduce themselves. But I think generally speaking, taking the topic quite broadly, this is a passionate one for me. It's one that speaks straight back into Africa and looks at all the meanings behind a lot of what's required to be able to allow further investments into market structures. So maybe we'll probably start from the end, and then you can sort of introduce your way all the way down here, and then we can get into it.
Sure. My name is Faraz Ahmed. I'm the group CEO for Sarafu. We are a payments and fintech company based in Tanzania, and a little bit different perspective on this. I'll be talking a little bit about the deployment of the capital, particularly on the SME side, and we have some thoughts and ideas on that.
Hi there, I'm Conrad Am. I'm the Group CEO of Skybound Capital. We're an asset manager focusing on private market investments. We are licensed and regulated in 4 jurisdictions. So we're in South Africa, we're in Mauritius, we're in the United Kingdom, and we're in Australia. We have a team in Africa of 72 people. We look after now about $2 billion in assets under management. Our flagship fund is the Prism Income Fund, which is a private debt fund, which we launched. We started the business 16 years ago, and we launched the fund about a year after that in 2009. It's delivered a return to investors of close to 8% per annum in US dollars. Globally diversified, but primary focus on Africa. We have over 30% exposure to Africa, and emerging markets over 40%. And we have a sister company, Tabridge, which focuses on structured trade finance, as well as invoice financing and invoice discounting.
So this is the very reason why he had to do it himself. Please go ahead, Abdel.
I am Sharif Abdelail. I'm working as a regional head of mergers and acquisitions with Camco Invest. It's originally a Kuwaiti-based company. It's asset management and investment banking. We have offices we are covering North Africa and GCC and some European companies. We have offices in Egypt, UK and Kuwait, Saudi Arabia, United Emirates. And we have around $16 billion assets under management, and we are active in the investment banking functions in the region and real estate investments as well. Thank you.
Hi, everyone. My name is Mike Mompe from Enza Capital. Apologies to everyone who's here for the exits session because you're going to hear a repeat of my intro. Enza is derived from the Zulu language. It means to build, to make, and to create. And we back founders and teams using technology to solve large and meaningful problems across the African continent. So we're a multi-stage venture capital fund investing from pre-seed through to Series B. We've made about 52 investments across North, South, Anglophone and Francophone, West and East Africa. And we have been around for about 5 years. I think I'm hearing billions over here. We're more on the millions side, so we managed about $60 million for venture that's meaningful, but very, very early in the life of our firm, and happy to be on the panel with you all.
Ed?
My name's Ed Higginbottom. I'm Managing Director of Verdant Capital. Verdant Capital has 2 business lines. We have a mezzanine fund, which is investing principally in digital finance and alternate credit. And we have an M&A business, one of the largest M&A business operating on a Pan-Africa basis, South Africa, rest of the continent, predominantly private market transactions.
Thank you, gentlemen. I think in terms of private capital market, is there really private credit and sorry, do we see private credit and mezzanine financing expanding? Maybe Ed, I'll start with you, and then I'll work my way back in this direction.
So we have seen private credit and mezzanine lumping those 2 asset classes together for a moment, although they are different. We have seen them expanding in the overall private capital market in Africa, which is probably slightly smaller than it was 10 years ago. What we've not seen is the same relative growth that we've seen in the rest of the world. So over the last 15 years, private credit and mezzanine globally has grown to be a $3 trillion asset class. And there's a lot of commentary in the market about it doubling again over the next decade. And that's partly driven by change in regulation and changes in particularly how the banks are regulated coming out of the great financial crisis or the global financial crisis in 2008. And I think in Africa we have seen a shift to private credit and mezzanine, but that shift's been quite slow. And if we think about private equity, we think about venture, we think about private credit, mezzanine, we think about real assets being infra and real estate. Well, private credit has grown. General private equity shrunk a little bit. Venture and real assets has also grown. And actually, I think there's a lot more scope for growth. If we look at the last 10 years, private credit and mezzanine has consistently outperformed private equity. Clearly, we'll be very careful what we say because, if everybody jumped into mezzanine funds and there was no equity funds and no venture funds, then, private credit wouldn't do very well either, right? So, we do need to make sure that the ecosystem supports all the different types of assets and to support multiple different managers with different strategies. But over time, we do expect an expansion in private credit and mezzanine.
Thank you, Ed. Mr. Mompe, what would you say would be your view when it came to the same question?
So I'll answer from the venture perspective.
Yes.
And venture, unfortunately, on the African continent has been kind of copy and pasted in many ways from Silicon Valley. And the capital markets function completely differently in terms of the depth, the speed, the scale, the sophistication even. One of the other elements that has been kind of copy and pasted in some ways has been kind of venture debt. And there have been very few instances of venture debt or what we might call kind of more mezz style firms and vehicles on the African continent. But what we have seen and what we have done as well is we have, I think, structured more of our kind of venture capital kind of equity investments to be a bit more venture debt-like. So as a firm, and we've started seeing this more broadly, structuring more off-ramps and liquidity within the initial investment, just given the challenges that a lot of the capital markets investors and entrepreneurs are kind of seeing when it comes to achieving liquidity. And one of the trends that we have seen across most sectors in which we invest is that someone might be building for either logistics or health or education or fintech, but ultimately the data enables the consumers ultimately to get access to capital because people are so capital starved. And what that leads to is it leads to a lot of founders building in Nigeria, Egypt, Ghana, South Africa, who are borrowing dollars to scale a balance sheet that is actually kind of hugely exposed to local currency. And it just is, it's a problem that, with enough time will blow up. And we've seen examples of this already blowing up. And so we've seen local facilities increasing. We see some of the DFIs that are backing that. That's fantastic. Local institution as well. I heard someone from Ghana, from maybe AFSIC, who's kind of pushing local facilities. It's one of the things that we have also said, how can we, given that we have this kind of flexible LP base and flexible capital structure, not just be equity investors, lean more towards venture debt, and provide the companies still an attractive risk-adjusted return to us, but a flexible capital structure for them to grow. So perhaps where we share that FX risk, and that flips into equity rather than being a cash burden on them. So we're seeing kind of innovations. We're doing things like that with some of our investments, trying to structure things to be more appropriate for the market to ensure that we're getting liquidity, but to ensure also that we're not putting too much pressure on the company so that they fail and that the equity goes to zero.
Thank you. I'd also like to get a certain perspective, Sheriff, and this one will probably start with you. And I'm looking at, so we talked about one aspect of it, but we probably want to also look at the securitization, the evolution of the securities market and how that has also covered different jurisdictions, given the fact that you also work across Africa. Maybe your sort of view that sort of touches on that as well.
Sure. I can as well cover a quick point for the mezzanine financing. Yes, it's very important and growing now in Africa, especially North Africa and other jurisdictions. However, the hurdle is from the perspective of the family offices because they are the end user of this or bottom line user. Sometimes they are not that much sophisticated to understand what is mezzanine. We educate them and show them a successful cases, and it comes with some problems or obstacles for them that it is mainly in a dollar based, and if they don't have any exports or if they don't have dollar revenue, this will expose them to the FX problems that the continent is facing. This is one hurdle. The other one is that it comes with a higher cost than the traditional or classical borrowing. So this makes for them sometimes a problem they don't accept, and they prefer to go to the traditional borrowing. However, it supports the growth. Coming to the point of the securitization question, that the securitization market in the African continent had grown eventually over the past decades very well, with increasing activities in specific markets or leading markets like South Africa, Nigeria, Egypt, and Morocco. Initially, the constraints for the securitization was the regulatory constraints and the development of the regulator and the underdeveloped financial markets, or they need more maturity. However, the securitization now is gaining more momentum in the markets and the countries, and countries now seek alternative opportunities or investing sources from capital markets other than the classical ones. So the securitization is very important, and it provides a good source and a quick source of financing for the infrastructure and real estate and consumer credit and other sub-segments in the financial markets. We saw that South Africa led the continent in the securitization, and countries like Nigeria and Egypt are following with an enhanced regulatory platform which is supporting the growth eventually, and rising investor appetite for this after having an educated market and consumer. It's the markets now, like in Egypt, we can see that most of the securitizations are supported by financial institutes and non-banking financial institutes like the leasing companies and microfinance companies and all of the other players. And it reached in a country like Egypt 100 billion Egyptian pounds this year, which is a massive number and a liquid market. However, still the problem facing the African markets in the securitization is that there is no secondary market for offloading this securitized papers, which I think it's still developing. In the same time, the fintech is supporting the securitization market very well. That's it from me.
Thank you, thank you. So I often tend to hear about a lot of the problems which you've kind of outlined. Maybe Conrad, in your response, you probably would want to tell us some of the things that are not being done in this area to allow the evolution to fall into what would then be seen as a progressive evolution that develops into something maybe more positive. I don't know if you could just give us your take on that.
Yeah, I mean, I think I can talk a little bit about, on the private credit side. I think that the comment that was raised earlier is there's more money going into sort of private credit. I mean, we're in the private debt space. And I remember having a gentleman, or actually a very wealthy family, in the office in Cape Town, and they'd made all their money in private equity. And he said he was coming to have a chat to us about private debt investing in South Africa and globally. And he said to me, yeah, no, we're shifting out of private equity. And I was like, sure, you've done so well in private equity. He said, no, there's a couple of key reasons. One, I mean, you've got security sitting in private debt. You've got defined exit in terms of your maturity, and the rate of return has picked up significantly in the sort of private debt markets globally, not just in the South African marketplace. Mm-hmm. So I think it's an area we do support, and there are investors and funds in here that we support on the private equity side as well. But I think it's sort of they're blending into each other. So that you look at private debt deals where there's a convertible factor, so that you can pick up some of that potential upside. Because we get very involved in the companies that we work with. We actually, in significant positions, we're taking board seats, so we're quite active investors, and we've got a big team of people traveling around Africa and the world to get involved in these businesses. So you want to pick up some of the upside, and there's also on the debt, you're going to be provisioning, and there's going to be problems with some of the debt positions that you've got. So it's always nice to have a little bit of equity carry in some of the good businesses as well.
Thank you. Thank you very much for that. While I still have you talking, I want to talk a little bit more about Mauritius. Yeah. Mauritius has been one of the big, strong leaders in this area, and the environment that it's created is one that I would call you very knowledgeable about. And so I'd like to hear your perspective on, over the last 2 to 3 years, what options have actually made, what options have fund managers been able to put into this for it to become a gateway of some sort, as we tend to refer to it?
Yeah, sure. Look, we've got an office in Mauritius. We've been there for over 15 years now. Our fund manager, Rob Smith, is actually out at the conference this week as well. So we've seen Mauritius on the grey list, going back onto the white list. So regulation has improved. I think the implementation of policies was critical. The FSC got involved in the asset management companies. They got very involved in the actual management companies on the island, making sure that the AML CFT policies were implemented. So I think governance has stepped up a lot in Mauritius. Substance requirements have really also moved up dramatically. You have to have your compliance and your AML and your CFT and your investment team. Our investment committee is actually chaired and driven from Mauritius. So regulation has picked up. And then I also think, I mean, from a tax perspective, it's an incredible jurisdiction. There's 15% flat tax on income, but there's no capital gains tax, there's no dividend withholding tax. And with global business companies, if you want to operate in Africa, I mean, there's DTAs with over 40 countries that Mauritius has got in place. So there's a lot of advantages having head offices and operating through into the Mauritian environment. I also think from a stakeholder perspective and enablers, the Economic Development Board, for me, that sort of sits between the private sector and government. We have worked in the last 2.5 years, very closely with the Economic Development Board on a solar project in Mauritius. And they've been incredibly supportive over a long period of time. They have an initiative called the Premium Investor Certificate, PIC. And here, if you're investing more than 500 million rupees into the Mauritian market, into sort of innovative technologies, infrastructure, clean energy, that type of thing, you can receive additional tax benefits to the tune of, you may be able to get a tax sort of rebate for 8 years, and if you apply through the PIC and you get approval, you can get up to probably around 14 years. You get sort of fast tracking on freight, you get 0 rating on VAT, you get sort of reduced transaction fees on property transactions as well. So there's a lot of support if you are able to get the PIC, and as I said, that's about 10 million euro investment through onto the island. I mean, another organization that we've worked with over the last probably 1.5 years now is the Mauritius Investment Corporation, MIC. And you know, they were initially set up really during COVID to provide longer term debt funding at very cheap rates to hospitality, travel and leisure. But the MIC so probably deployed now over $1 billion into various markets in Mauritius with more than 50 businesses. But they are looking at equity investments now. If you think about Mauritius as an island, they want to be 60% onto renewable energy by 2030. The MIC is going to have to be involved in that process. And we are seeing more sort of equity opportunities coming through there. And they're really an accelerator of growth in the island, in particular in the clean energy and the sustainable and innovative technology space. And then, I mean, if you look at sort of the banks, I mean, MCB did a big Eurobond listing, $300 million at 7.95%, and was listed, it was actually the first Mauritian corporate to list in London. So some good fundraising, and that's pricing at 107 now, which is really good. And then MCB has been quite involved, and there's an African domestic bond fund that's been listed duly. So it's in Botswana and it's in Mauritius as well. So yeah, I think they raised about $40 million, which gives you sort of local currency exposure, so sovereign debt exposure in a local currency through an ETF exchange. From a structuring perspective, we use a protected cell company structure in Mauritius, which just really means you've got a global business company, you're licensed through the FSC, the regulators, you've got your administrators, your audit, your bank account in Mauritius, but each cell is ring-fenced from a legal perspective. So that's one vehicle that works well for raising funds to deploy into Africa. They've got a variable capital structure that they've implemented now as well. There's GPLP structures. They run open-ended, closed-ended. There's no, I mean, there's multi-currency jurisdiction. The stock exchange is multi-currency. So I think it provides a good access point and a lot of benefits to funds and investors coming through Mauritius into the African marketplace. We've definitely found that.
Thank you. Thank you for the deep insight. But Firas, I know that payments and fintechs have been a strong area for you in Tanzania, but maybe we can hear your perspective on it when it comes to Mauritius and how it.
Yeah, sure. Yeah. So maybe I can just pick up on a thread that Mike had raised on the cut and paste experience or reality that's happened at least in Africa over the last 2 or 3 years. What I've seen in the market in Tanzania. And we have a holding company in Mauritius as well, but at least on the ground in Tanzania, what I saw was a lot of capital coming in without really the ecosystem and the infrastructure to absorb it. And so what happened was it was almost like a transfer to local consumers, because these startups were spending a lot on customer acquisition without really achieving any value creation or a serious customer base, because they would just go away when the price went back to normal. So that that aspect of the capital market which exists in Silicon Valley, which is grow as quickly as you can and will eventually save you so that you can keep growing more, that was not there, right? And so I think that mind shift has to happen across the board, right? And we're in the payment space, but also in the e-commerce space. We saw it in a terrible way in the e-commerce space in East Africa. You saw a lot of big players who've, I would say, at least $500 million in US dollars of capital went into that space, and I think very little is going to come out of it. And that was based on this assumption that eventually the customer growth will save you in the long run. And I think for us, and what I've seen effective in Tanzania, and what we've done in particular, like let's say take BNPL for example. If you go into Africa with a BNPL product and you don't have an ecosystem in which you can understand how that fund is being used, you'll probably lose it. And so what we've done is we've built payments and commerce together so that when you are funding, say, a BNPL product, what are you funding? Let's say you're funding a particular type of asset or some type of working capital. You can make sure that that fund is spent in that direction using the infrastructure we've built. So we have a commerce engine, we have a payments engine. You marry them together, all of a sudden, you can't spend that money except through the commerce engine, right? And so that type of thing, I think, is where the future of kind of making sure that you're not chasing something that isn't actually there. You're not chasing a ghost. You're chasing something real.
Yeah. Thank you for that. And how has your experience and the impacts of the FX also played in your experience within the markets that you're also operating?
Yeah, so you certainly don't want to be in a position where you're chasing dollar returns on local currency revenue, right? Local currency revenue is going to fluctuate, no question. And so what we've had good experience in is providing services to people looking to deploy capital in those regions. So for example, like one partnership we did was actually, in fact, on the philanthropic side, where they were, this was a charity sending food into Tanzania, right? And that was US dollars coming in. And we were able to deploy in Tanzanian shillings. So that was quite an effective approach for us, as opposed to the other way around, which is, trying to generate the revenue in Tanzanian shillings, then send it out in US dollars, which would have been much more difficult, given the scarcity of dollars all across the region. So you got to be very careful which one you pick.
Yeah. Should I add a little bit to that?
Yes, please. Yes, please. Go ahead.
Yes, I mean, I think there's always going to be a shortage of dollars in Africa. I mean, also, we deal with providing funding to some of the microfinance businesses in Africa, and they're receiving dollar funding, and some of them are getting dollar funding in anything 8, 12, 14%. But if you add the cost of hedging onto that, you're taking those cost of capital up to sort of north of 20%.
Yeah.
So what we're looking at doing is actually, taking those African currencies, if possible, into rand. You need a sort of a listed futures contract on the JSE to do that. And the JSE is, a highly regulated market, a lot of governance around that. I mean, the rand is trading $17 billion a day on average in FX. This is very liquid. I mean, unfortunately, it's quite volatile. Ed and I were talking about this, extremely volatile. I mean, I think sometimes use it as a proxy. If people are nervous about emerging markets, they short the rand. But nevertheless, I mean, once you've got rands, then there's a lot of optionality to do dollar, euro, sterling, but in particular, dollar options, collars and caps around that. You can actually, look at it as a position in the portfolio. So I think there are ways of potentially, taking African currency through rand and providing a cheaper hedging than going, for example, shilling straight into US dollars.
At what scale does that become viable?
Yeah,
Just given the costs and...
Yeah, so I think, we are testing this out at the moment in shilling. And I think we're going to start very small.
Shilling.
Yeah, very, very small. So you've got to have a listed forward contract on the JSE. So they're not too many. I know there's one in, I think there's a Pula one, there's a shilling one. So the other angle that we're looking at is, so for some of the African countries, it's an anomaly, but you see, if you're sitting with currency earning interest, you actually can find that sometimes you get paid more interest in US dollars. There's a couple of African countries where that exists, which is strange. But so in those situations, we've got a dual fund structure, so an offshore Mauritian fund structure and a South African fund structure. So we can actually create an African currency class, bring those funds back into Rand, into South Africa, and then using asset swap capacity. I know there's exchange control in South Africa, but literally, I mean, asset swap with big institutions is almost unlimited. Right. And you can asset swap out then. So you take your Rands, you get a forward return of 3 to 4% or even more sometimes, depending on which currency you're going into. You go into the private debt markets offshore, pick up 7, 8% yield, add those two together, you got a 10% type return coming through to an African currency offshore class in your debt fund. So these are things that we're working on just because of, as you said,
Right.
just the lack of dollar capacity, the cost of dollar in Africa.
We'll be in touch after this.
Yeah.
So Mike, to your question, so Verdant Capital Hybrid Fund is a dollar fund. We can invest in dollars or we can invest local currency. If we invest local currency, we hedge. If we invest dollars, it's a contractual requirement for the borrower to hedge. And we're doing small deals. We're doing investments of $2 million to $10 million, and at all of those sizes, we found availability of hedging. I think the market's very different to 10 years ago. I think 10 years ago, all the borrowers wanted local currency, and they wanted local currency. You sent them a dollar quote. That's like, chuck it away and come back when you understand what local currency means. But the world's moved on. I think a lot of the more sophisticated operators on the continent want a dollar deal and to hedge it themselves, because there is a withholding tax savings if the borrower hedges themselves. And of course, they've got a lot more flexibility of how they manage the risk around the edges. Do they do a 1-for-1 swap, or do they do 10% out the money type hedges? And there is a little bit of an overlay between currency risk and currency hedging costs and credit risk. And it does give it is actually kind of just easier to manage that on the borrower side than the lender side. So 90% of the discussions we have today are around dollars, with the understanding that the borrower will hedge.
I think we are squeezing into our time zone here, but I have one other question that kind of dovetails nicely into all of this. Maybe everybody's most feared question, exchange control. And I know you touched on it a little bit, Conrad, but I think maybe I'll let Mike open this one up, and then I'll let Sheriff sort of follow it through, and then anybody else if all of you have something to say on that.
Frankly, we don't have any particular insights on exchange control. It's something that we, as part of business, when we're investing directly into a company that is domiciled in one of the operating countries, then that's something, and particularly in South Africa, as well as Nigeria, that's something that's been a challenge. Increasingly, what we have seen, especially in the early stage venture capital markets, is we have topcos domiciled in Delaware. So 80 to 85% of the companies that we're investing in are actually US domiciled. And so the exchange control impact is actually quite different. We're Mauritian domiciled ourselves, because, as you said, the DTAs and everything, historically that used to be the case, but now we have venture capital firms like Sequoia, Index, Greycroft, some of these kind of multi-billion-dollar firms investing into African businesses. And I think they would be unwilling to invest into codes that are not domiciled in Delaware. So frankly, we don't have much of an insight on that. So happy to hand over to colleagues on the panel who
I'll ask Sheriff to actually pick this up, because then it sort of dovetails into the problems that we face in Africa.
Yeah, again, that's one of the extreme important problems that face all of the continent, unfortunately. It's the impact of the currencies and devaluation. It comes on historically on the back that most of the countries in Africa used strict controls over the exchange rates, and that impacts not only the availability of the currency in foreign currency, but also the investments itself. So having a strict controls, this allows for the gap between the actual or the central bank rates and the parallel market or the black market. But I think that currently most of the African countries have passed with this pain process, and they are under programs with the IMF, so they are more flexible and more transparent on the currencies, which is helping some countries on the economical growth. However, it's impacting very high expenses and high inflation rates. Countries try to overcome this with a high interest rates from the central bank and the banks to consume or absorb the liquidity in the market. So it's a kind of dilemma. However, it's being in a better shape than the last couple of years. I think especially after the COVID, it started to be more significant, and after the war with the Russian-Ukrainian, and after all of the events and incidents, all of this pressured the currencies in Africa, and it pushed the governments to have real solutions or a long-term solutions, diversifying sources of capital and supporting the capital markets.
Thank you, thank you. And from a real practitioner who's in the markets where he's also exposed, maybe I'll probably take one from you, and then Ed, you can.
I'll just make a quick point. I mean, I think it also depends on the economy of the country itself. So our experience in Tanzania, actually quite a bit of manufacturing happens on FMCG products, daily consumables within the country. So you don't see as much exposure. Although it's certainly there, you see inflation in the market, and it does impact certain consumer behavior. But at least in Tanzania, we haven't seen it as much. But like a neighbor like Kenya, where it's not as much the case where you're manufacturing those daily consumables, it has a bigger impact. So I think it's not even a problem that is uniform across the continent. I think you got to look at it market by market. That's been our experience.
Ed?
I think the good news is, from an investor point of view, but also from the underlying economies, is the big issues with the big economies with exchange controls have released and relaxed those exchange controls over the last 12 months. So we've been seeing Ethiopia, Nigeria, and Egypt, all three large economies, 3 of the 10 largest economies in the continent. As of 12 months ago, they had very strict and very complicated currency control regimes. Availability of dollars were rationed. The consequence of that is there was one of a vibrant black market. And secondly, nobody brought any money into the economy. If you're going to do a deal as a foreign investor into one of those economies, you're buying naira, you're buying birr, or you're buying Egyptian pounds at the official rate. And of course, when you want to exit, the only way to exit is to exit the black market rate. So it's been really challenging for those economies, and I think it's a very good thing that they've largely relaxed those exchange controls. They've moved to much more market pricing, and we track, as a firm, we track the spread between the black market rate and the official rate. And Egypt, Nigeria, and Ethiopia are now down to 2 or 3%, whereas a year ago it was 100% one day, or 50%, or 75%. So these are 3 great economies with great people and great entrepreneurs and great businesses, and it's good that they're back and investable again.
Thank you very much. I think generally speaking, to be able to harness a good and a very strong environment as well, we talk about all the solutions, but I think there's also a lot of hope for countries to put in the structures that would also help keep the right type of people or have the right type of knowledge around a lot of capital markets and where it's going. And I think that's an area that most of the African countries also need to support, because through that, then you're impacting right on regulation. Often at times, fintech and the others tend to lead regulation. And so it's getting to the point where eventually they do catch up, but it makes sense for the structures within Africa itself to also cater for some of these things, to be able to make our lives a lot easier. But I do love the fact that we've got ways of doing new things and good things, and being able to trade in currencies that other people traditionally wouldn't think about doing it. And this can be expanded across. But otherwise, I'd like to thank my panelists for being very knowledgeable and educating us this afternoon and giving us the confidence of growth. Thank you.